Hi, I'm Peter Rose, founder of Longwood Currency Trading. There are three reasons why your Forex entry trade always goes against you. Don't you feel that that's what happens? It's not in your mind, and it's not because you're stupid. It's because there's three specific reasons why your trade is guaranteed to go against you. Now, is there any way to beat any of those? No. It's always going to go against you. So what do? Why bring this up, this message of doom, if there's no solution to it? Well, because that's part of the game. You wouldn't go into a poker game and expect that you weren't going to lose some money just by stepping into the game. Your ante is, that's a loss because it isn't coming back to you unless you win the pot. So the three reasons that the trades always go against you, just for those of you who are cruising aimlessly and all you want is information and a magic pill answer, the three reasons are the spread, the slippage, and it's 50-50 jump ball anyway. Okay, now you can go watch Mr. Beast. For those of you that are still here, thank you. The spread, or what I call the VIG, it's the difference between the bid and the ask price. Generally, if your broker is good, you're somewhere in the 3/4 of a pip to a pip and a half. Generally, you're going to pay at least a pip and a quarter on your spread. The bid and the ask is about a pip and a half, a pip and a quarter apart. So you buy at one and you sell at the other, and so that trade's going to cost you, regardless of whether you just enter the trade and come out at the same price. You're losing a pip and a half. That's the spread. I call that the VIG. It's like the ante that you put into the table when you sit down to play cards. That's the broker charging you that spread. You have to be careful with the brokers too, because when they quote the spreads, are they quoting both sides for the complete trade, or are they quoting it on a one leg? In other words, you'll see a broker, well, our spreads are the least. It's the three quarters of a pip. Well, yeah, it's 3/4 going in and 3/4 coming out. It's a pip and a half. Come on, who are you shitting? You have to be really careful with this stuff so you don't lose too much. You're going to lose on the spread, but don't lose too much. The next is slippage. The slippage is caused by the lag in the time that the broker receives your request and their ability to execute that. The Forex market is so liquid that generally those trades get executed right away. But if you're trading at a slow time, or perhaps it's even at a really volatile time and nobody's interested in this little piece there, you may jump over that and you may not get your trade filled until a little bit later, or it may be grossly against you. So you have that slippage thing. You have to remember too that the broker is taking the other side of your trade. All brokers do that, okay? I mean, you don't find a broker that's large enough to be in the interbank market, because to be in the interbank market, it's a Citibank trading against Bank of America or Deutsche Bank. You're not going to go in there as a broker and say, you're not going to call Deutsche Bank up and say, oh, I got 500 lots of Euro USD. And yeah, they're not going to pay any attention to you. So they have to take the other side of the trade. It isn't they're trying to fade you. They just don't have the capitalization to be in the interbank market. Well, Peter, where are they getting their prices to quote you? They take the 6 major banks, or 4 of them, or whatever they're capable of doing, and they average the price at any time. So what you're seeing is bid ask, and the actual price is an average over 4 of the interbank players. So there's a delay in time for all those calculations to be done and for you to get that price when your order hits them. That may change. That quote that you're receiving may not be the quote that the the interbank is providing in their averaged values, it doesn't make any difference whether the trade gets executed or not. The broker is going to take that trade, but they're going to take it on the averaged value of those four that they have. And that's going to create some slippage sometimes. You won't notice that. You say, hey, I want my trade at 1.5550. And they'll get it to you at 50. But it'll be out at that fifth decimal place that you're gonna find that sludge factor going in. So when your end of the day closed position goes through, the fact that you're missing out at the fifth decimal place 0.00005, almost a half if you're $1,000 at the fourth decimal point, this may be 50 cents that worked against you at that last decimal point or something like that. You have to be aware that you're going to get this kind of slippage de facto. That's just the market. You can't fight that. And the third reason has to do with when you put that trade on, it's 50-50 jump ball whether it's going to go up or the price is going to go down. You may have done entry analysis that says in the long term, now that long term may be 20 minutes or it could be 20 days. Doesn't make any difference. That next tick, right when you hit that button, be 50-50 jump ball. So you take the spread and you take the slippage, and now you're adding on a 50-50 chance against you. It's 100% for certain, even without the 50-50, it's 100% certain that price is going to go against you. Now, how far does it go against you? Well, at a minimum, you're losing 1.5 points. Let's just call it that. How does that affect your? If you can't avoid that 1.5 points, then why would you put a 5 pip stop or an 8 pip stop? Because you're losing 20% of that. It goes 1.5 points against you, and you get a 5 pip stop. You're over 20% of your position. Where does that leave you with stops? I think that's why a lot of folks advocate these 20 pip stops, because they're trading with brokers that are not giving really clean data because they don't have a really good connection to these whoever these banks are. But if you're trading with a reputable broker whose trade execution is reasonable, why would you take a 20 pip risk? Yes, for sure you're going to lose 1.5 points. For sure. And you're probably going to end up losing 2, maybe 2.5. And you get a bunch of people going in at the same time, and that's reflected in the price. You're going to see that price go. You're going to take the trade, everybody else takes the trade, and that price goes down. You thought it was going to go up, but it goes down. It goes down 3-4 pips. So you can't have a 5 pip stop. But why would you have a 20 pip stop? Well, that's your decision to make. I have specific guidelines that I use that are in my rules that I share with the students that I have. We talk about this kind of stuff. And it's really your decision as a trader. How good are you? What's your win-to-loss ratio, your average win value? What's your expectation over the long run for your portfolio? Where do you see yourself as far as your expertise and be able to judge the directional movement based on the bias that you see in the long-term trend coming out of that? Maybe if you're a day trader coming out of the 4-hour or maybe in the daily chart. All those things are in consideration as to where you're going to put your stop or how far, and the currency pair too. I mean, if you're going to trade an exotic, you may be having 5-minute bars that are 20 pips. Whereas in your, I just trade the majors, and they're all US based in the majors because USD right now is the default currency, reserve currency. A 5-minute bar is basically 5 pips. It could go 3 to 8 pips, somewhere in that range, but generally you're going to average out ATR 5 pips. The currency pair that you trade has a great deal to do with the placement of your stop. On my channel, I constantly talk about this stuff, and people contact me and they say, well, you're just crazy. You couldn't possibly trade like that. Well, no, I can, but you can't, because you don't understand the mechanics of order flow and broker operations that's acting as a go-between between you and the interbank market, except there's a time lag of 10 hours or whatever it is when you enter that trade before that broker flushes their whole positions out into the interbank market. Those are just the rules of the game. If you don't understand the rules of the game, order flow and broker interaction, those two things, you're not going to be successful. And you can do all the technical analysis in the world that you want, but that technical analysis is not consistent with the pricing that you're seeing, because the pricing on the broker screen is not the pricing. It's the average pricing over 4 to 6 of the largest interbank traders in the world. So what is a Forex price? Maybe that's a better question. That would be a nice question for another video. That's interesting stuff. If you want to get into that, let me know. Peter Rose, Longwood Currency Trading. Have a great day and have a great trading day.